Let's welcome on board Rohan Suryavanshi from Dilip Buildcon and analyze how their earnings have been. Rohan, hi, morning. Good to have you on the show. Predictably so, COVID has dented your first quarter growth, but it's surprising to see that you've still are indicating a strong order inflow at about 8,900 crore rupees till date. Tell us what's the gestation period for these orders and what gives you conviction that these kind of order momentum are going to continue going forward as well?
Hi, Aisha. Pleasure to be back on your show. Yes, you're right. The quarter obviously was impacted by COVID, but in the good news, again, like you mentioned, is we've had a very strong order book. The orders that you mentioned, that 8,900 crores worth of orders that we have won, these are orders which are spread across different verticals. We have dam irrigation orders there. We have tunnel orders there. We have a special bridge order here, and then we have road orders. So all of these have different lead times. From 2 years to 4 years, and these orders will start sort of giving us revenue in the later part of this year, which would be about end of quarter 3 to starting of quarter 4 is when we should see meaningful or revenue coming from all of these orders.
Sure. What can you tell us about execution though? Has there been a pickup or are there still COVID related issues like, labor, raw material, etc., which are acting as hindrances?
The execution has definitely picked up from, when the lockdown was imposed. We've started seeing reverse migration of now laborers coming back to sites. We've also started seeing all the raw material supply chains that were disrupted. We started seeing normalization in those. We started seeing alternate sort of options coming on. So all those things have come. As if I speak about right now, 90% plus of our laborers have come back to sites, and all the raw material disruptions are sort of behind, with the exception of barring some site or the other which might have a local disruption because of the district administration call. Otherwise, it is work as usual. The only thing that is impacting right now are the monsoons. Because we've had good monsoons across the country right now. So that is obviously impacting work for the industry as a whole.
And what is the outlook on your working capital as well as your overall debt? Do you think we could see an increase in FY21?
So, for the past couple of years, we had been focusing on debt reduction and working capital cycle improvement, which had also seen like our debt equity ratio had fallen to 0.81 last year from 1.06 the year before. So we had seen a steady and a very meaningful reduction in that. However, now this year, because of COVID and because of the impact that's had on work, we obviously availed moratoriums, and we've also availed, whatever facilities the RBI has given us. So that whole exercise which was going on has obviously taken a little bit of a detour, I would say, but it is very much on the line. This year, I think, from the numbers that we have in terms of the current debt numbers and the current working capital cycle, the numbers will not go up from here. It will actually reduce, and this is all obviously dependent on how the rest of the year looks, and hopefully we won't have any more large disruptions or shutdowns, because all those things will obviously impact revenue and profitability. So this number, the quarter 1 numbers, is probably on the most that we should see in a year, barring maybe a little bit of disruption, but otherwise at the end of the financial year we should be lower than this.
Okay. And what about the execution level now? Have they come to the pre-COVID levels? Have you seen an increase? Are things picking up as we are seeing relaxations eased?
The execution levels have also picked up as the relaxations have come in. Because of, like I mentioned earlier, availability of labor back on sites and availability of raw material, execution has come on track. Even if you look at this quarter, our revenues were only reduced by about 17% as a year-on-year basis from last year same quarter, which is exceptionally good as opposed to the industry average of about 40% plus reduction in revenue. So if Here, our business model of having our own people, having our own equipment, doing everything on our own without any subcontracting has definitely helped us in getting this revenue and being ahead of the curve when the recovery came.